All right, today we are going to rank a number of tax opportunities, strategies, incentives, or tips for individuals and sole traders and see if we can find what are the better ones and what are the probably not so lucrative ones. Because a lot of people just list out tax tips and tax ideas and give them equal weighting, whereas I find there's a few opportunities available to us as individuals or employees that if we're looking to grow serious wealth or long-term wealth, we might want to put more time and energy into. So I've gone and created a tier list, which means I'm going to rank a number of these opportunities or incentives available to us based off the tier list system, which is S, A, B, C, and D. S being superb or super, and then A, B, C, D based off the alphabet. So the higher it is, the higher I rank it, the better it is, in my opinion, that is. So this is all opinion based. I'm not an accountant or a tax professional. I'm just a humble servant to the ATO looking to find and work out what are the better opportunities that they provide to us as Australian taxpayers. One tax tip I will provide you before we start though is that sometimes it's not worth spending $1 to save 45 cents. So some of these will apply to your situation, what won't. So don't stretch yourself out too much or stretch yourself too thin trying to chase tax savings, because sometimes they're just not worth your time, effort, and energy. With that said, let's go into it. I've got things ranked alphabetically, so there's no preference to the order they're going to come in. So first one, we've got co-contributions. Now, the co-contribution scheme is an initiative to help low to middle income earners boost their retirement savings. If your income is below the higher income threshold limit set by the ATO, which is around 60 grand in 2024, you have the opportunity for any post-tax contributions made to your super account to be matched by the government. Now, I find this is a pretty good, I'm going to put this B, because if you put in $500, you can get $250. If you put in $1,000, you can get $500. I've been doing it for a number of years through my wife's account. It's been a fantastic way to get money from money, which is not always easy to do. What else have we got here? Donations. Donations, I'm going to put them at the bottom because, yes, it's nice to make donations and have them tax deductible, but the reality is, as an Australian on an average income, making donations for the tax savings isn't that valuable to you. You can deduct that from your taxable income, which is great. I donate for the sake of donating as opposed to tax benefit, which is a bonus, but that's why I've got it lower down the list. The first home super saving grant, I'm going to put that C, so you can make before tax and after tax contributions to your super to save for your first home up to $15,000 per year for a total limit of $50,000 over the years. The tax advantages here are that you can utilize your concessional contributions here, which is likely lower than your marginal tax rate. Concessional contributions are taxed at 15%. And then when you're ready to buy your home, you can apply to withdraw these contributions. Yes, it's good because you can get some concessional contributions, which are taxed at that lower rate going there. Maybe I'll put it one higher. I think, for most people, this will not apply if you already bought your home or living in your house and bought one previously. I might put it up to B because the opportunity is there for you to quickly grow $50,000 through a decent environment, being the super fund process, super fund environment where you can invest your money in markets and so forth. What have we got? Gearing. So gearing is when you borrow money to invest. So that could be for a house or investment property or shares and things like that. Now, the advantage here is that money that you borrow to invest can be tax deductible. So interest on your investment loan is tax deductible. If there's a mortgage for an investment property or paying off investment or margin loan or something like that. It can also give you the opportunity to hold on to more cash flow. So, for example, you don't need to outlay all the money that you have saved. You can do a portion of that. I'd say this is very opportunistic. If you have the opportunity to buy an investment property or set up a portfolio using gearing, it's good to have leverage, but I wouldn't go chasing gearing. What do we got? Income protection insurance. That's boring, but still a deduction you can make. Insurance is something you can get inside or outside of super. Easy enough to do and something you can just get a tax deduction on. So I'll just put that in C. Okay, so now I've got low cost assets. So low cost assets is the next one, and the ATO allows immediate deductions for the full cost of assets that are less than $300. Some of the eligible assets include tools for tradespeople, office equipment, computer equipment, technical books, small appliances or tool, computer there. It's quite good. If something's under $300, then you might want to consider whether it's applicable for the low cost asset deduction there. I wouldn't go out of your way buying a lot of stuff just to get this low cost deduction available, because again, you might be spending $1 to save 40 cents. So do the maths there for yourself. But it's reasonable if you need these type of assets anyway. Next, we've got motor vehicle deductions. Look, I'm going to put this down the bottom because for those who use their motor vehicle a lot for work, generally have that paid by their work. And they normally get a company car or a fleet car or get petrol paid for them or an allowance and something like that. So it happens throughout the financial year as opposed to the individual having to load up on paying for motor vehicle deductions and then getting them paid out. But look, you can tell me in the comments if I'm all wrong about this, but things like fuel and oil, repairs, maintenance, depreciation, you can claim, registration, insurance. If that is of a sizable amount, I would say your company probably should be paying for that. If not, then you can obviously deduct it. It's nice to think that motor vehicle deductions can be claimed, but unless you've got a job that's heavy on the road and your company won't pay for it, then probably could go higher up your list. This is my list, so it's down the bottom, and I barely ever claim a motor vehicle deductions. We've got pension mode. Oh, I like pension mode. Transferring your money. I'm going to put this up at the top, not top tier, but this is pretty good, especially for those entering retirement. When I talk about pension mode, I mean transitioning your money in superannuation from the accumulation phase, which is a taxable environment, to pension phase, which is a non-tax-free environment. And to do that, you need to meet one of the conditions of release. The beauty of pension mode is that you get no earnings tax, you get tax-free withdrawals, and you get some flexible retirement planning options there, like the TTR, transition to retirement strategy that you can set up. So if you hate tax and you meet one of the conditions of release from retirement in the eyes of the ATO, then consider pension mode. Talk to your super fund if you like to know more, and I'm not providing a clear enough explanation, but I think pension mode, for those especially 60 plus, is a fantastic way for you to just avoid more tax altogether. All right, next one is, got some good ones here. Rental properties. I've owned investment properties. I've been a landlord before, and pretty much every expense, well, I shouldn't say every expense, a lot of expenses can be written off through your tax return. We talked about gearing before. We've got payments for your mortgage and your interest repayments. But then with rental properties, you've got basically everything else in the apartment or the house or the unit that you have can be deducted. So you've got depreciation on the item. So if you've got an air conditioner, you can write that off for over a number of years. If you had to replace the oven during the year, that can be a deduction. The agent's fees. There is a whole list on what you can deduct. The ATO will provide you all that. But if you do have a rental property, make sure you are claiming as many deductions as you can. The caveat obviously here is that you need to own a property that you rent out to get there. Look, there might be opportunities for you to rent out properties and get some serious deductions there. But again, you're not going out of your way to buy an investment property just for the deductions, are you? I know some people love the thought of negative gearing, but I don't like the word of anything negative. So it's just me, and I'm out of investment properties at the moment because of the involvement needed there. Even with tax time, there's a lot of involvement just to get all those claims and deductions made, but they can be highly, highly valuable. Let's keep moving. We'll get there. Salary sacrifice, no-brainer A for me. the opportunity there. I've got another video on contributions where I talk about salary sacrifice. It is a bit tricky to understand first time, but the reality is if you work for an employer, you can ask them to put more money into your super fund pre-tax, which is what they do already through the super guarantee, which means you pay less income tax, get less take-home money, but you are ultimately putting more money getting more of your money into the super environment and receiving a decent tax cut on the process. Also, the flexibility of salary sacrifice is fantastic. You can turn it on and off like a tap. You can contribute an extra $100, $1,000, 4%, 2%. It's up to you. You have that discussion with your employer. They may have some limits on what you can and can't do, but the reality is it's a fantastic way to ramp up your contributions, especially concessionally, where you get only 15% tax taken out as opposed to 37+% as an employee. So easy A for me. What else we got? Self-education. This is like motor vehicle deductions, where self-education, you can only claim on courses and training and things like that if it relates to the job that you're doing or connected with or working on, or the environment that you're part of. So like motor vehicle deductions, I believe this is something that should be covered by your business. Any training that I need to do for my job is paid for by my employer. I don't really necessarily have to get out of pocket too much for self-education. Maybe if you're doing an MBA and then the business says we'll only pay for half of it and stuff like that. I believe MBAs are worthless in the modern era anyway, but I don't see it as that lucrative. What else have we got here? This one, your sole and principal residence. Now this is going to the top. This is going to the top. And the reason why is because of what's called the main residence exemption. And it's a tax benefit available to us Australians who sell their primary home, which is the residence where they live most of the time. And so under this rule, the main residence exemption, any capital gain, the profit from selling their property, is exempt from capital gains tax. This means if you sell your house and make a profit, you won't have to pay tax on that profit generally, as long as it's been your main home during the period you own it. So this is where a significant amount of Australians have made their wealth, in buying and selling their homes that they live in just over and over the years. And, if you talk to many older Australians, go back and talk to them about the history of properties. And I know there's many who, bought their first home, renovated, moved in the second home, did some work to it, lived in it for a number of years, made millions and millions and hundreds of thousands of dollars just because they've lived in their house, its value's gone up, and they've sold it, and they don't have to pay any tax on that. So you could buy a house for $200,000. No, it's not a realistic example. You could buy a house for $800,000, renovate it, sit on it for 10 years, sell it for $1.6 million. You don't need to worry about the tax office there, and do that again and again and again. And that's how a lot of people in Australia have made their wealth, due to the nature of the country living and the way property works. All right, we've only got 4 more. Let's see if I can speed through them. Tax agents. Yep. So that's getting your money back on tax agents doing your tax returns. That's middle of the road. If you pay someone to do your tax, you can claim those fees on your next tax return. That's kind of bread and butter deduction there if that happens. Tax offsets. So there's the low income tax offset you can get, which is money put into your super fund to offset the tax that you pay on your concessional contributions. I think if you earn under about $37,000 in 2024, that's just something that gets deposited into your super account after you do your tax return. And then there's also the spouse tax offset, which is the opportunity for a couple to put money into the other's super fund if they're below an income threshold, and get a tax offset for that. So we're talking about sort of $500 a piece here for a couple of offsets there. Again, this is sort of middle of the road. It's not going to change your life, but if you stack these up and do them year after year after year, that's hundreds of dollars a year that you can build in your super fund and supercharge your retirement fund there. Working from home deductions, boring, they're uninteresting. What are they like? You need a new keyboard, a new mouse and stuff like that. It's not going to give you much in return, but it's just something that is a byproduct of you doing your job, really. And again, that leads into work-related deductions. There's a lot in there in terms of what you can deduct, such as your uniforms, mobile phone, internet, and stuff like that. Again, you're not going to get too much money unless you're very particular with this. Union fees, computer use, subscriptions, stuff like that. You can put it all down. Again, you're getting deductions. You're not getting your money returned to you. So it's not that lucrative, but I'm going to put that in at C. So that wraps up my tier list. That's what I think. I don't know. Let's zoom in a bit. What do you think of my ranking? Is this where you would see it too? I've actually got this tier list tool available publicly. So I'll put a link in the description. You can have a crack at it yourself. Tell me where I've gone wrong with this. Tell me what you like. Tell me what you don't know about that you're wondering about the opportunity of. But, hopefully this is better than me just reeling off 20 tax tips and, I don't know. Do your own research. Don't take what I've said for granted. Again, I'm not a tax pro. I'm just some guy pressing buttons on a screen. So just want to get a conversation going. Thanks for watching.